Hi, everybody, and welcome. Thanks for your patience as we're allowing folks from the waiting room. I believe we have everybody in. I'm just double checking on the side here. A couple more still coming. Okay. Please feel free to use the chat button on the bottom of your screen if you'd like to communicate at all, if you're having any problems. Okay, wonderful. One more moment we're going to give for folks to come in. Great. Well, welcome, everybody. I really appreciate you coming and joining us to learn a little bit more about charitable giving and how to do that in a tax-friendly way. And I'd like to extend my thanks to Rich Shapiro, who's joining us here as my co-host today, bringing his expertise to us and sharing ways that we can give charitably in the best way possible. Many of us open our checkbooks every day, but we don't know how to do some other things, such as stock transfers, etc. And I hope we come away with a lot of great information from today's session. So thanks for joining us, Rich.
And my pleasure. Thanks, Nicole.
I'd like to just start with a quick video that actually I had Rich's assistance on that talks about charitable giving. It's a very short video that we actually have right on our community foundation website at cfosny.org that you can share at your convenience. You can also go back to the website and view. And I think it's a really great introduction to what we're talking about today. So I'm going to just take a moment and share my screen and share that video to start. You recognize the importance of giving back, and nonprofits count on your generosity. Have you considered the impact you could have if your gift continues forever? By designating a community foundation in your financial plan, you can make a difference for generations to come. Lifetime gifting to charity may save on your income tax now, in addition to reducing your estate by the amount of the charitable gift. There are many tax-friendly ways to give. When you give a gift of appreciated property, such as stock, you receive a tax deduction for the value of the stock without paying income tax on the gain. By naming the community foundation as the beneficiary of your retirement account, you can avoid passing on potentially significant income taxes and estate taxes to your heirs. If you create a charitable remainder trust, you can get an income tax deduction now and an income stream from the trust for your lifetime, with the remainder going to charity at the conclusion of the trust. Anyone over the government-designated age can make a qualified charitable distribution from the traditional IRA provision. And you can consider a charitable leave trust either as a lifetime charitable gift plan or as part of an estate plan. The Community Foundation can also be designated as the beneficiary of a life insurance policy. You can earn a tax deduction, and the policy proceeds will one day support causes you care about. With so many ways to give, the Community Foundation can work with your trusted advisor to find the best fit for your financial and charitable goals. Reach out to us today and plant the seed for a legacy of giving. Okay, thank you and for listening to that. But I feel like when I listen to that, oftentimes I have more questions, and I feel like probably many of you do as well. I'm going to try to stop sharing my screen here if I can. And I'd like to be able to hand it over to Rich. So, sorry, folks. Trying to figure out how to.
You have to enable my screen sharing.
There we go. Okay, so we should have Rich back here. And I have to enable your screen sharing. That's cool.
Right.
Okay.
You should, as a host, be able to now share your screen.
Okay, let's see. Yeah. Yep, now I can.
Great. Thanks, Rich.
Okay. So I just want to make sure, can you see, Nicole, what's on the slides?
Yes, I can.
All right, fantastic. Okay, everyone, thanks for joining us today. We'll get the show on the road and try to walk you through some of the various avenues of charitable giving. Of course, in an hour, we're not going to discuss every possible solution and method, but hopefully there'll be enough of an overview to give you some insights on various techniques. And we're going to spend a little bit more time on some of the giving of stocks directly and most particularly IRA contributions. So before we get into that, if you do have a question here or there, I assume you can post something in the chat and we can address at some point during or at the conclusion of the slides. So I'm going to get going on that. Let's see. Okay, there we go. Just some slide about me. You can, I assume Nicole can provide the PowerPoint to everybody who needs it, or I can. So we're going to move to what I call the charitable planning pyramid, and this really incorporates all estate planning goals and objectives. But the two that are really listed here in terms of the philanthropic angle that we're focusing on today is really the two primary ideas that surround why people typically make charitable bequests. And there's really two of those. One is what we call the pure form philanthropic motivator, that people are donating really because of an intent to give. And then we have the tax planning motivator. And it's often not one or the other. There's sometimes a combination of those things. My experience is more people are motivated by the pure form of the true philanthropy than the tax planning, but certainly the tax planning angle doesn't hurt and gives people additional incentive to do some charitable giving. And there are still some, and as various tax benefits have been washed out of the tax system over the years, the charitable planning is one avenue that is still quite robustly supported by state and federal tax policy. So with that being said, we're going to move on to the types of charitable organizations. There are really three primary types. There's the public charities that we're probably most familiar with, the community foundation being one, our local hospitals, libraries, Cancer Society, you name it. They're 9 times or 90 out of 100 times, 99 out of 100 times, probably going to be a public charity. Private foundations are those established by individual or family members, typically because they want to have very targeted, very controlled methodologies of charitable giving. So if you watch PBS, and a lot of their programming is sponsored by private foundations, the Ford Foundation, Carnegie Foundation, so on and so forth. But they're relatively smaller in comparison to the vast array of public charities out there. Then there's sort of a hybrid type, the supporting organizations. It's a little less formalistic than a private foundation. Essentially, it's an entity established to allow people to do targeted philanthropy, not quite as broad-based as a private foundation, and somewhat less onerous of the reporting requirements than would be a private foundation. For tax planning purposes, public charities are subject to better tax benefits for the donors than private foundations or supporting organizations. The government has made a public policy determination that we rather support and provide more incentive to supporting public charities than private foundations or supporting organizations. So how do we make charitable gifts? Well, this is this listing is the primary methodology of doing so, starting, of course, with your outright gifts. You can donate annuities or life insurance. There's ways to establish a pooled income fund as part of a gift. We use those a lot in Medicaid planning because they have some real advantages there. Of course, there's testamentary gifts at the time of death, either through a will or a living trust. There are various charitable trust structures that you can establish during your lifetime, and we will spend a little time at the towards the tail end on one methodology of using a charitable trust with IRAs. And you can make direct gifts of retirement plans to a charity that also can have some significant tax benefits. Outright gifts take the form of everything from just writing a check, donating a property. You know, you'll hear the Cars for Kids commercials, which stick in your brain, and donate your junk cars. And of course, volunteering time, which is an enormously powerful way of doing philanthropy. We don't think of it because it's not giving stuff. Giving time is sometimes the most valuable thing we can do. So a few of the techniques I'll spend a few minutes on to establish a gift annuity. Essentially what you do here is you donate a sum of cash or some marketable securities, which does give you probably a little more bang for your buck than cash because of the avoidance of capital gains tax. But regardless of what you use, you donate those items to a charity. The charity in turn will pay you or your designee fixed payments for life. And if you're setting the annuity up for yourself, what you donate will not be part of your estate, and no estate tax will be due should it be an issue for your particular circumstance. Because part of that gift is for charitable purposes and part comes back to you, there's a calculation when you establish the annuity that will show you which part is tax deductible for income tax purposes and which part is not. And you are able to defer some of the capital gains on gifts of appreciated securities. You'll be getting back some form of capital gain along with ordinary income, but you'll defer it over the period of years that the annuity exists. Life insurance is pretty straightforward. You would name a charity as the beneficiary of your policy, and or you can actually change ownership of a paid up policy to charity, which will remove the entire value of that policy from your taxable estate. What's nice about insurance is that if you're regularly giving to a charity in the first place, by using life insurance, you're leveraging your gift because the death benefit will almost certainly exceed what you're paying into the policy. And therefore, if you are giving $1,000 to a charity for your life every year, but you instead allocate that to some form of life insurance, you'll probably get a lot more than $1,000 a year worth of benefit that the charity will ultimately receive. Testamentary bequests, those are very common, of course. So you can put in your will or living trust, upon my death, I give X dollars. Here we're using example 100,000 to Crystal Run Village Foundation, or I give my ranch to the American Cancer Society. So you can do so in a living trust arrangement, as I mentioned earlier, or what's called a testamentary trust, which is part of a will. And that can again be established to benefit a particular charity, even if you don't want to make an outright bequest. Maybe you want to give the $100,000 to Crystal Run Village Foundation, but not all in 1 year. So you can leave a trust in your will that says, I'll give, $20,000 for up to 5 years to be distributed by this trust. So you can be as creative as you and your professional advisor you work with are able to come up with, and whatever you want to do can get. That objective should be obtainable through some form of estate planning. So
a quick question from the chat below, Rich. The question is that whole life or term only?
It can be either. I see Chris asked that question. It can be either. It can be either whole life, term, universal. Of course, the one risk with a term policy is that you may outlive the term. And then, of course, as you get older, term typically becomes expensive. You might get a fixed term of 10 or 20 years. But if you really want the charity to have the gift, you're probably going to want to have some form of permanent insurance that you cannot outlive, or the premiums will not go up beyond what you're willing to pay. That's a very good question, because term is great, it's cheap, but it's not really the best vehicle for an ongoing charitable donation.
Great, thank you.
Yes. So the deductions you get for various charitable contributions are really straightforward here. If you make a cash donation, then you can write off up to 50% of your adjusted gross income off the top line. So if example, your gross income is $80,000 a year, if you make a $20,000 donation to a public charity, you're only going to be taxed on a top line of $60,000. So that's a pretty easy way to reduce your taxable income. Focusing on stocks, and this is really where you get more leverage. Cash is nice to give, but you don't get as much bang for your buck as you would if you have appreciated assets. And this slide gives us a good example of that. So if you own stock that you paid $5,000 for, but is now worth $20,000, if you sold the stock as the owner of that stock, you're going to get a reduction because of capital gains. And if we're going to assume a 15% federal rate plus 8.8% New York rate on a $15,000 gain, that would result in a tax of about a little under $3,600. If instead you make that contribution to the charity, you'll receive a tax deduction for the entire $20,000, since there's no diminution for capital gains tax. So if the charity sells it, they do not pay that tax. And of course, you're not paying it because you didn't sell it during your lifetime. So appreciated securities or other appreciated assets, including real estate, can be wonderful ways to incorporate philanthropy with some tax planning. So that's all good. Now, there are limits in terms of the tax deduction less than the cash, where you get a 50% option or opportunity against your adjusted gross income. When you make donations of stock to public charities, the tax deduction limit is 30% of your AGI. When you do it to a family foundation or supporting organization, it's lower, 20%, again, based on public policy incentives. One nice thing, though, that this can be very helpful if you're making a particularly large donation. Any unused excess deduction can be carried over for up to 5 years after the date of the gift. So this is a way to do the gift that keeps on giving back to you by carrying it over for a year plus 5 and really helping minimize your income tax obligations for that long a period of time. Just from housekeeping kind of stuff, when you make a stock donation, there's a form, IRS Form 8283, that is used to memorialize that donation. If you hold the stock less than 1 year, if you're flipping or a day trader or something like that, the deduction is the cost basis or the current fair market value, whichever is lower. So there is some disincentive from a public policy perspective from doing a churning of stocks for the purpose of making charitable gifts. So we're now going to move ahead to a conversation about what I call bunching deduction or donations. A couple years ago, with the change in the tax laws, we saw much higher standard deductions. Back when the law was implemented a couple of years ago, it was $24,000 for a married couple. In 2022, the standard deduction is up to $25,900, which is helpful in many ways. Without itemizing and all this, you can still get a nice nice big deduction. The problem is, though, in the charitable planning world especially, if you don't make charitable gifts that are large enough that when added to your other itemized deductions, that if they don't exceed the standard deduction, then you really don't get any additional benefit from the charitable gifts. So here's an example. So let's assume you have a $9,000 standard itemized deductions a year in the year, property taxes of 11.9, and you make 5,000 in annual charitable contributions. The total of those three items equals the standard deduction. So that's what you're going to get anyway. And so your charitable gift, charitable donation doesn't really add any bang for your buck from a tax perspective. It may feel good that you're helping, that's great, but from a tax planning, it doesn't work, or it doesn't help you. So let's instead consider this. Okay, you have your stock worth 25,000, you have a cost basis of 5,000. Instead of just making a $5,000 cash donation, if in 2022 you donate the stock worth $25,000 to the public charity, and then just don't make any gifts for the next 4 years, you certainly can, but for my illustration, we're not. Then for 2022, your itemized deduction based on all those same numbers from the prior slide would equal 45,900. And at a 40% tax bracket, you'll say 40% of that 45,900 in income taxes that you would otherwise owe, because you are in excess of the standard deduction, and by itemizing, you get the deduction on that entire $25,000 charitable gift. So over the next 4 years, whether or not you make any charitable contributions, you'll still get that same standard deduction. Now, of course, this number will almost certainly go up each year, so we just know what it is today. And so even though your actual deductible expenditures were only 29,000 for your for the regular 9,000 of itemized deductions and your property tax exemptions, you get the full use of the deduction, whether or not you make any of those charitable gifts. Ultimately, by donating the stock to the charity in that 1 year, you avoid, in addition, the capital gains tax that you would have recognized on the sale, which further equates to a tax saving of a little under $5,000. So bunching deductions is really a useful way of looking at ways to continue to receive income and capital gains tax benefits on our donation to charity. So it takes a little bit more mindful planning if you're looking to do it as much for the philanthropy as you are for the tax planning. So, but again, not here to discourage people from giving every year. We want people to do that, but if you want to do a big chunk of something, do it in 1 year. So then we get to the IRA piece here. IRAs, as we know, often carry severe tax penalties, and not penalties per se, they're tax implications. Unlike capital gains, which, federal rate is either 15 or 20%, depending on the duration and so on in your tax bracket, IRAs that are traditional IRAs, we're not talking about Roths here. And by the term IRAs, I'm referring not only to IRAs, but 401ks, 403bs, and other tax-deferred qualified plans. When you receive distributions from those IRAs, each distribution is treated as ordinary income. So it's going to be taxed at your personal income tax rate. And if you're taking especially large distributions, that can certainly bump you up into a higher, if not the highest, tax brackets. If instead of you taking distributions from your IRA, you direct those distributions to one or more charities, you can substantially save on your income tax obligations. So if you're charitably inclined, giving these tax-deferred assets to charities results in more for your family and more for the charity. Only Uncle Sam or I guess we call our Aunt Kathy up in Albany, not Uncle Andrew, since he's no longer governor, would lose out on this arrangement. So the government has had for the last number of years a technique or a rule permitting what are called qualified charitable distributions, or QCDs. QCDs is simply permit individuals who are 70 and a half or older to donate some or all of their required minimum distribution, what we refer to as RMDs, directly to a charity. The Secure Act, which was enacted in 2020, raised the RMD age to 72 from the prior 70 and a half. However, the QCD age remained at 70 and a half. So even when you're 70 and a half or 71, you don't have to take a distribution. You can still take advantage of the QCD rule and allocate an amount from your IRA directly to a charity. QCDs do not provide you with a direct charitable deduction, even if you itemize, so that it doesn't help with that, but it does reduce your taxable income, and often considerably so. So some of the benefits of using a QCD, it may help you stay out of a higher income tax bracket if the RMD is paid directly to charity rather than to yourself. It may help you avoid the 3.8% Medicare surtax, which is based on your modified adjusted gross income. So if you're limiting distributions from your IRA to yourself, you can avoid that surtax. Also, because Social Security benefits become taxable if you have a certain level of income, by again avoiding taking this income, you may keep yourself below the threshold amount for taxation of your Social Security. And also because your Medicare Part B and D premiums are likewise based on your adjusted gross income, this will help keep or can keep your premiums lower if that is an important thing for you. So a lot of things to consider when we're looking at whether to take your RMDs directly or donate them to one or more charities. So some of the rules that apply here, as I mentioned earlier, you have to be at least 70 and a half to take advantage of this. Even though you're eligible to take penalty-free distributions from your retirement accounts after 59 and a half, you can't take advantage of the QCD rules until you hit 70 and a half. Your limit on utilizing this technique is $100,000 per account owner, but you can exceed your RMD if your RMD is below 100,000. So if year one your RMD is 30,000, but you want to use 50,000 as a QCD contribution, you can do so. Just a simple, mechanical rule: the donation can't go to you and then to the charity, because if it comes to you, you're going to get the tax. It must be directed directly from the IRA to the charitable organization or organizations, not limited to just one. And the QCD applies to pretty much any qualified retirement account, including IRAs, rollovers, inherited IRAs, inactive SEPs, and simple IRAs. Inherited IRAs can be a useful tool as well because of the 10-year payout rule that's now in effect that I'll spend a few more minutes on shortly. So one little tweak to know about the QCDs is that these rules only apply to taxable distributions. So if you've made non-deductible contributions to an IRA, which some people have done, then there'll need to be a calculation prepared to differentiate between the taxable distributions and the non-taxable distributions. Mechanically, to report the donation on your 1040 tax return, you must first list the entire IRA distribution on the line for IRA distributions as if you've received it yourself. But on the line of the 1040 for the taxable amount, you'll enter 0, assuming that you've allocated the entire QCD distribution to the QCD. So the QCD is a very helpful and powerful tool. Again, it doesn't have to be all or nothing. If your RMD is going to be 40,000, if you want to take 20 for yourself and do the 20 QCD with 20, any amount is fine as long as it's under $100,000 in a given year. And this is the kind of thing you should be talking to your professional, your financial planners, and your CPAs about how, if at all, this can be integrated in your philanthropic planning. So there's one other technique regarding retirement accounts that I think is fantastic. And I think more people should consider these under the current rules that are in effect. So that technique incorporates using a charitable remainder trust with an IRA. Why this has become more of a interesting concept is since the 2020 Secure Act that went into effect. For most beneficiaries, the stretch IRA is no longer available. So for the majority of beneficiaries who are not spouses can still do the same rules as prior to the Secure Act. You can do spousal rollovers to become an owner of your spouse's IRA. For younger spouses, that makes sense. But even if you're older than your deceased spouse, you can use the remaining life expectancy of that now deceased spouse, the hypothetical life expectancy. All those rules remain in effect. Where the rubber has met the road, though, and where the rules have become much less favorable for our non-spousal beneficiaries is that, with limited exceptions, and those exceptions apply to disabled beneficiaries or minor beneficiaries under the age of 18 in New York, those people can use life expectancy. But for a minor beneficiary, once you hit 18, then you're back on the 10-year track. But for everyone else, from day one, you must take your full IRA distribution within 10 years of the original IRA owner's death. So it's really 10 years beginning the year after the death of the IRA owner. Prior law, you could take life expectancy payouts, and that can have rather dramatic impacts. So one exception to this, if you don't meet any of the other exceptions of a disabled beneficiary, for example, is rather than naming an individual as your beneficiary, you establish and name a charitable remainder trust as the beneficiary of the IRA. And the way the charitable remainder trust works is basically as follows. Well, first of all, it essentially mimics the life expectancy treatment of your pre-Secure Act stretch IRA. After the lifetime beneficiary's death, or the end of the term if there's a set term, the remainder of what's in the CRT will pass to one or more charities that are designated in the CRT. So let's talk about a sort of an example of how this could work. Let's assume John inherits an IRA from his father that has $400,000 at the time of his father Al's death. If under Secure, so this is a post-2020 death, John is obligated to withdraw the entire 401k or entire IRA worth $400,000 within 10 years after Al's death. If John, just say John decides, and there's no requirement you take in equal distributions over that 10 years, but let's assume he does. If John takes $40,000 in year one and is in the 20% income tax bracket, he'll pay $8,800 in additional income tax in the year of withdrawal. Assume rather than naming John directly as beneficiary, Al creates and names a CRT as the IRA beneficiary. We can further assume that the CRT is established as what we call a unit trust that provides for John to receive annually over his life expectancy or for a fixed term of years, not to exceed 20 years, 7% of the corrupt principal. And the valuation is done as of 12/31 of the preceding year. So if John is 40 and they set up, as I would imagine you would, a life expectancy payout, he'll get 7% of whatever is in the CRUD as of December 31st of the prior year every year. And that number will adjust either up or down depending on the performance of the investments in the CRT. So in this analysis, upon Al's death, the entire $400,000 will be retitled in the name of the CRUT. That's what we call a charitable remainder unit trust. So since the transfer to the CRUT as a charitable entity is tax-free, or charitable trust, I should say, the CRUT trustee, who can be John in this case, can say, okay, I'm going to take all that UPS stock that my dad acquired because he worked at UPS that would otherwise, we'd worry about capital gains tax, because with an IRA, one thing important to keep in mind, you don't get a step up in cost basis of the underlying assets as you do with non-retirement accounts. If he inherited $400,000 worth of, I'm just using UPS as an example, UPS stock through his dad's living trust, not part of his IRA, then he would get a step up to the $400,000 fair market value as of date of death. With an IRA, you don't get that. And if you sell the IRA, the assets in it, there'll be capital gains tax owed. Being paid to a CRT, you don't have that capital gains tax recognition. So John, now having diversified the assets, he invests in various bonds and growth stocks that will net the trust, not him, $4,000 income after various expenses. In the first year, John will receive his 7% payout of the $400,000 trust corpus, which equates to $28,000 distribution. From that distribution, the taxable income is $4,000. So from this total distribution of $28,000, John is only paying $880 of additional income tax on that distribution, which is 22% of the $4,000 of taxable income. Compare that with the $8,800 of income tax that he would pay upon taking the entire $40,000 distribution if he is named directly as the beneficiary. So for many reasons, I think this is something that people should be focusing more on. I've had some conversations with people about it, but it sounds a little exotic to people, and I think it's sometimes hard to get them to sort of see the dollars and cents benefits. I think the younger your beneficiary that you're leaving for, or that you conceivably are going to leave for, the more merit it has, because the longer their life expectancy, the longer this is all stretched out, and the bigger the tax bang for the buck, as it were. So, so I'm going to sort of wrap up here, and I know we'll have some time for questions, with a little story that I call the free bridge. So this is a quote from a figure. We'll get to that in a minute. So what he said was, I live in Alexandria, Virginia. Near the Supreme Court chambers is a toll bridge across the Potomac. When in a rush, I pay the $1 toll and get home early. This is a while ago. You can see if the toll is just $1. However, I usually drive outside the downtown section of the city and cross the Potomac on a free bridge. The bridge was placed outside the downtown Washington, D.C. area to serve a useful social service, getting drivers to drive the extra mile and help alleviate congestion during the rush hour. If I went over the toll bridge and through the barrier without paying the toll, I would be committing tax evasion. However, if I drive the extra mile and drive outside the city of Washington to the free bridge, I am using a legitimate, logical, and suitable method of tax avoidance and am performing a useful social service by doing so. For my tax evasion, I should be punished. For my tax avoidance, I should be commended. The tragedy of life today is that so few people know that the free bridge even exists. Justice Louis Brandeis. So we all have a free bridge we can choose to take or not. And I think there are many opportunities for us to take the free bridge that we're not taking today. So if nothing else, hopefully I provided some food for thought that can get you thinking about either for yourself or people in your orbit who might take advantage of some of these techniques. This is really some great opportunities. And I really, the QCD is great, but I really think the CRT strategy with your IRAs is a home run in so many cases that we should be looking at. So that wraps up my formal presentation. I don't know if there are any other questions that people have, and I'll do my best to answer them, but that's all I got. I guess I can stop sharing my screen in a second here. Let me get back to Zoom. Oh yes, stop sharing. There we go. Aha.
Very helpful, Rich. Thank you very much.
Oh, wonderful. Thank you, Chris.
We'll take any questions that anyone has in the chat bubble at the bottom.
They're either sleeping or mesmerized. I don't know which, or both.
I could also try to share my screen again and provide a little more information. I know that didn't work at the beginning, but I can certainly try it again. All right, let me see here. I'd like to provide a little bit of information about how the Community Foundation can play a part in all this. So let's see if I can share my screen. So it looks like you have to give me that ability again. Looks like it's swapping back and forth between you and I.
All right, let me see what I have to do here. No, that's not right. Participants. So I have to click on you to do something here? I'm trying to remember.
Yeah, I think if you click next to me more, you should be able to give me hosting abilities again.
Sorry, what do I have to do?
Let me see. I think you can give me hosting abilities again.
Oh, more.
Mhm.
Make co-host.
There we go.
There you go. I didn't know you lose that status. There you
I
go.
know, I think I did. All right, so let's see if I can share my screen again here. Okay. Everybody see the video now?
I can.
Yeah.
All right, perfect. So we'll make that nice and big.
It's a PowerPoint, I see.
Oh, you see the PowerPoint?
Yeah. Not the
Oh,
video.
okay. That's odd. All right, let's try that. You see the PowerPoint?
That I see.
All right, wonderful.
Try again.
Okay, so you see the mission screen right now, Rick?
Yeah. Yes.
Okay, wonderful. So a little bit about the Community Foundation, because I think a lot of what Rich was mentioning really can apply to starting a fund here at the Community Foundation. Everything from, the advantages of bundling, especially to the fact that we can accept all sorts of gifts. So a little bit of background about us. We were created back in 1999, expanded to Sullivan in 2007, and currently manage over 360 funds with assets of $50 million. $25 million in grants and scholarships have been distributed since 1999. Many of those are from donor advised funds. And as was discussed, there are a lot of advantages to starting donor advised funds. 5 full-time professional staff here at the Community Foundation, 27 members of the board of directors and active committees. Rich is actually on our board of directors as well, so we thank him for his service, and 9 clean financial audits. So say this makes a lot of sense to you. You realize that you could bundle, and that would make a lot of sense for your charitable giving instead of writing a check every year. How do we get that started? Well, just a simple fund agreement outlining the name, purpose, and details of the fund to document your charitable intentions, a transfer of funds here to the Community Foundation, and our annual administration fee is just 1 to 1.5%, depending on the type of fund, and another 0.36 for investment management. So the services provided by CFOS. So you start a fund here, and what happens? Well, any donations that come into that fund receive written acknowledgement. We prepare quarterly fund statements. And as the fund rep, you have access to online fund portal for balances, donor history, to make disbursements each year. Assurance that the funds are used in accordance with the intent of the donation in perpetuity. It's nice to have those checks and balances of that legal agreement and also the board of directors overseeing these funds. And you will have your own fund page on our Community Foundation website with online donation link, again, that people can make donations to that fund as well. Other services provided, marketing support as needed, listing in our digital annual report, inclusion in our annual audit to assure financial accountability, access to our staff for assistance, and prudent stewardship. So over the last 10 years, our performance has been 8.2%. So when you think about it, creating a fund and then doing your charitable giving yearly with a disbursement from that fund can make a lot of sense as far as bundling, like Rich had mentioned earlier. Okay. Did any questions pop up in the chat in the meantime? I think it looks like we're just getting some compliments for you, Rich, for a great presentation.
Thanks to all.
Wonderful. Well, I want to thank everybody for joining us. Certainly reach out to me should you have any questions. I will be sharing this PowerPoint with everybody. There's also been a lot of requests for folks to watch the recording, so that will be posted on the Community Foundation website as well. And I just want to thank Rich for joining us and for providing a lot of in-depth information that is very helpful. And I want to thank everybody for coming out tonight and for bearing with me at the beginning for my little technical difficulties. Everybody's been a great audience, so thank you so much.
Thank you all.